Hello, everyone. I'm Bruce Meyer, editor of Rubber and Plastics News, and welcome to the second week of the International Tire Exhibition and Conference, the virtual edition. We hope you enjoyed all the presentations and networking from the first week, and we promise you that this week will be just as informative. And to kick off week 2, we have a real treat. Our keynote speaker for this session is Jeff Schuster, President of the Americas Operations and Global Vehicle Forecasts at LMC Automotive. Jeff oversees the Global Light Vehicle Analytics team and activities for both sales and production forecasting. He also is responsible for the leadership and direction of detailed trend analysis for the OEM Group segment, platform, model, and plant level reports. Jeff has been tracking and analyzing developments in the global automotive industry for more than 25 years. He is widely quoted by the automotive media and frequently makes industry conference and seminar presentations. Today, his talk is titled Automotive Outlook and Path to Recovery. After his talk, Jeff will be answering questions from the viewers. If you have a question during the course of the presentation, email them to rpnevents@crain.com. That's CRAIN.com. With that, I present you today's keynote speaker, Jeff Schuster.
Good morning, and thank you very much, Bruce. I appreciate the opportunity to be with you today. If only in a virtual setting, I wish it was live in person, but those are the conditions we're under right now, and I'm really going to take that and take a look at how the pandemic has affected the automotive industry and what's happened and how we see things transpiring over the next few years in terms of recovery. So we'll take a little bit picture around the world view. Before I get started, just a little bit about LMC in case you're not familiar with us. We are holistically focused on the automotive industry. So primary business is really engagement in forecasting market intelligence, trends, looking at sales production, powertrain, our big push into electrification. We have quite a presence in that, as well as further down the road into mobility and autonomous vehicles. And we do so in both the light vehicle market as well as medium and heavy commercial vehicles. So with that, why don't we go ahead and get started into the presentation. So as I said, I'm going to take us through the current environment, kind of where we are today, how we got to the current industry, as well as what the path forward looks like. So if we take a first step in terms of the auto industry, it's always good to start at a high level and look at how the economy is affecting the industry. And from an economic standpoint, looking at 2020 and into next year, clearly this year we're in negative territory really across the board. If you look at the global environment, we're at almost 4.5% decline expected in GDP growth. US has been outperforming that to some extent and actually has improved. The outlook has improved as we progressed from April until now. We're looking to be down just under 4%. Eurozone is a bit of a lag there at almost an 8% decline, and China is actually in positive territory, but the arrow is representing a decline from last year. So these are all markets that are down from last year's growth. China was closer to 6% last year. And then if we fast forward into 2021, we definitely see recovery across the board, strong growth recovery in the 4 to 5% range in most of the world, with China picking that number back up closer to 8% from an expectation standpoint. Now, these are coming off of a market that over the last 3 years have been hovering until we got to 2019, hovering in the 3% growth range. That pulled back to about 2.5% last year. One of the other major factors, I think, when we look at the auto industry and the sector itself is certainly is how are consumers behaving and how are they feeling about their situation, financial situation. Are they employed? What might drive them into purchasing a big ticket item like a vehicle? And I think if you look some similarities across the Eurozone and US in terms of consumer confidence, and this is looking at the Conference Board in the US, Definitely a substantial decline when the pandemic first hit. I've come back from that in both Eurozone and the US. US took a little bit of an unexpected pullback in August. I think most of that was the stimulus package coming off, the unemployment benefit coming off the $600 level, and we still haven't had that second deal yet. So I think that's having some impact on the US, although we do expect to see some sort of a deal take place before too long, which would likely see a rebound in the recovery that we're still seeing in the Eurozone. I think then when you look at other parts of the world, which I don't have on the screen here, but we see similar pictures in some of the major markets, Japan, Korea, South Korea, Canada, for example. From a lagging standpoint, though, the UK, confidence in China, even though things have really returned to as close to normal as they are anywhere in the world, but definitely lagging from a confidence standpoint, as well as India. So how does that translate into the auto sector? Well, let's take a first look at where the market is, where it's come from. This is obviously a very long view. You can see the Great Recession back in 2008, 2009. Then I think when we're looking at this, and see if I can use scroll here. So the decline back in 2008 and 2009 was substantial. We had quite a V-shaped recovery. However, look at the difference here. We've had, globally speaking, a much more pronounced decline. If you remember back in this period, 2008, 2009, China actually did not have this decline. They grew in this period. So there were some exceptions back then, which kept the volume really from going much lower from a selling rate than it did. Obviously, fell below a 50 million unit selling rate back in April. We've had a pretty strong recovery. We're now hovering in the 85 to 90 million unit. We haven't hit 90 million units since the pandemic started, but very close. And we're really projecting that to continue through the remainder of the year, kind of in that high 80 million unit selling rate. If we look at some of the major markets, and this is just really putting it into perspective around the world, you can see the declines much steeper. I do want to point out, I think this is the first time and hopefully the last time we see this happen, but I certainly have never seen this. India, 0 sales in April, 0 vehicles sold, 0 vehicles produced. So again, hopefully that's the last time we see that actually happen in a month. Deep declines across China, across Western Europe, certainly across the US, but at this point, that 2-month walk down certainly doesn't look as steep as as other markets. And we are seeing a fairly pronounced recovery in most of the markets. The US has not quite a classic V, obviously, but certainly getting back to a pre-COVID level from a selling rate standpoint. So when we look at the overall market, this is taking a look at light vehicle demand in the major markets around the world. And you see some consistency. Europe as a whole, North America, both behaving in similar levels, roughly 20% declines across those two markets. But you can see because of the lower decline in China, really driving the world here, as well as some of the other smaller markets, we expect the globe now to be down about 17%, coming in at about 75 million units. Just to put that in perspective, and I'll talk a little bit about this when we look more at the road to recovery, but things have improved a fair amount since we've started tracking back from April. So the outlook overall for the year is continues to improve, and I think there's still some upside momentum and possibilities even to the 75 million unit level. So again, at this stage here in September, the outlook is certainly not as bleak as it was back in April. South America, when we look at where the risk is, there's risk obviously around the world in we see various pockets of outbreak potentially causing disruptions in vehicle sales. South America, which has improved quite a bit, still down about 30%. So there's still a pretty substantial pullback in South America. One area of the market that has outperformed really total vehicles has been the electrification or the battery electric vehicle market. EVs, and this is through July, but EVs are down about 14% from where they were in 2019. And that's, as you can see, about 5% percentage points better than the global market, being down about 19%. So we continue to see a lot of activity. I'll talk a little bit about what that means on the path of recovery, but we definitely are seeing a significant amount of activity. There's a lot of buzz. If you look at the EV market and look at just the number of launches this year, and again, I'll focus a little more on that as we look at the next couple of years, but a lot of new brands are certainly looking to crack this market here in the U.S. as well as globally. The attention from a regulatory standpoint in China as well as in Europe driving a lot of these sales as we will look forward. So we take a view really at the North American market in particular, and you can see how that deviates a little bit from the rest of the world. So in North America, we're expecting the market to come in about 16.5 million units this year, down from about 1 million last year. You can see obviously because of the size of the U.S. market, it's going to make up most of that decline, a little over 3 million unit decline in the U.S. U.S. coming in at about an 18% decline, a little bit worse in Canada, but again, with the exception maybe of Mexico, those markets are improving substantially. Canada was looking to be down almost 30% back in April. So coming in at just over 20%, 22% certainly is better than it was expected at that point in time. And Mexico lagging a little bit. I think the controls in terms of the outbreak and just how that's being handled in Mexico is a little bit more troubling when it relates to the auto sector and how consumers are pulling back on their purchases. So looking to be about a decline of about 25% when we look at that market. So I wanted to take a couple of minutes to illustrate using the US, but to illustrate how things have changed. So this was our initial look at the forecast back in March. So we were looking at a market that was going to be down substantially. So the green line is representing the selling rate pattern that we were expecting before the outbreak hit. So we were looking at a market last year with 17 million units in the US. We were looking to pull back about 250,000 units. So we were going to see a market coming in at around 16.8 from an expectation standpoint. Obviously, the initial look at the forecast was a pretty deep decline. And even though it does have a V to it, was certainly going to take a little bit of time to get back to normal, or what was perceived a normal pattern from a selling rate standpoint. And that was going to happen towards the end of the year. If we look at now the pattern, so we do have a little bit different pattern. The decline, I'm gonna go back a slide, so just so you can illustrate that. So the decline is nowhere near as steep as it was looking or projected to be in the April and May timeframe. So we've outperformed expectations there, really getting down to about a 9 million unit selling rate. And then the recovery has been stronger than expected as well to date. So coming through August, I think, and I highlight the remainder of the year. So right now we're projecting things to stay below the previous trend line or expectations, the forecast. However, I think there's certainly opportunity to exceed the forecast, at least at this point in time. So a fair amount of uncertainty still ahead of us as we look at the remainder of the year, but I think there's definitely some upside potential, which I'll talk a little bit about as we look at the recovery path and the outlook. So I wanted to illustrate some of the metrics that we're tracking as well. So I think when you look at the declines on a year-over-year basis for each of the months, you can again see the pattern there. April was a low point at almost a 50% decline. We see the market kind of scratching back in May and June. July outperformed. August, there are some selling day issues, and Labor Day, as a reminder, was in the August numbers a year ago. So that 20% or near 20% decline is with 2 less selling days and also with Labor Day in the previous year. So we are seeing September exceeding those expectations. But I think if you look at that and average those out, you're still at a market that's in that 12 to 15% decline rate, and we do see that kind of holding through the remainder of the year. Some of the drivers, and I think some of the things that are a bit surprising, certainly is transaction prices. I think when you look at transaction prices really sitting at an all-time high, they're up about 7% from where they were a year ago at almost $35,500, coming from $33,000 a year ago, and that's the average across the entire market. And that is the transaction price after incentives are taken out, so kind of net of incentives. Incentives are down a little bit. I'd almost call that flat in August, but I think part of that has to do with the fact that inventory is at a extremely low level right now as well. So the manufacturers aren't having to use the incentives that they would have had to use otherwise. So all in all, it's from a health standpoint, it's still a pretty healthy market. I think when you look at some of the transactions and what consumers are doing when they're purchasing a vehicle, we see leasing coming in at 28%. So average lease prices historically lease percentages were in the 20 to 22% range. So leasing coming in and holding just under 30%, still a high level. We did see a pretty strong uptick in long loans. So those that are 72 months or longer, 41% of transactions that were financed were of 72 months or longer. So consumers are definitely managing monthly payments through leasing and through longer loans to get those payments down on the purchases, offsetting those high transaction prices as well. And then I think when you look at the industry and break it down into the body styles and look at the market overall, you can see, on a year-to-date basis, the overall industry, again, down a little over 20%, but a couple of highlights there. So the pickup and the SUV segments are definitely outperforming. Pickup trucks down just about 10%, so substantially outperforming the total industry. SUVs are down about almost 17%. So again, still coming in better than the overall industry. And that you can see when you illustrate that, the MPV or the minivan segment, the car segment overall, those are the segments that are getting hit harder than certainly the truck side of the market. I'd like to illustrate, even though inventory, again, coming off of a April where just about zero, we had only a couple of thousand vehicles that were produced in April. So industry is still trying to recover from that, which I'll talk a little bit about the inventory situation as we progress here. But I think when you look at that and look at the fact that there's not a lot of inventory, and the pickup segment is a segment that typically has a lot of different vehicle types needed, in a lot of different markets. So the fact that there's not much inventory out there and the sales are still performing this way, if the inventory was there, I think we'd see even stronger numbers in both pickups and SUVs. So something to keep an eye on as we progress through the remainder of the year into 2021. Taking a step back, looking at the globe again, and this is taking a look at the production levels for the light vehicle market, just to kind of illustrate where production has been hit harder. So that Europe down about 20%, North America down about 20%. The Asia, not including China, is down a little bit stronger. That's again going to pick up that 0% level that we saw in India, but also steeper declines in Japan, in the ASEAN market, and then actually Korea outperforming some of those markets. So not down as much in Korea overall, but as a whole, coming off about 4.5 million units of volume there. China, again, the outperformer, down only 2 million units or 8%, and the lagger at the same level of Asia minus China is going to be South America. So still a lot of troubles, I think, as I illustrated on the demand side in South America, And that gets us down to just under 74 million units. Globally speaking, a decline of about 17%. So I think when you look at the overall production picture and how plants were shut down, this is really summarizing that shutdown. Again, April was the majority of that. Obviously, it spilled into other months as well. But I think when you look at it, South America plants were down almost 12 weeks on average. You see North America coming in at about 7-week decline. Europe's right in there, a little over 6.5 weeks. China was down only 3 weeks on average. So obviously that's impacting when you look at those numbers and expectations for the year. That's why China we expect to be down only 8% as a result, because they don't have as much volume to try to make up from a loss standpoint. South America has much more volume to make up, but demand isn't there. So there's less of an inventory issue in South America. Both North America and Europe are hovering in a similar kind of pattern in terms of shutdowns, but also in terms of inventory as well. So a little bit about the inventory situation specific to North America. So this is kind of looking at the volume on a year-to-date basis. You see, again, because of that volume that was off in April, you see a substantial pullback. Overall, the industry is down in North America about 34%. Canada's a little bit stronger at almost a 40% decline. So kind of leading the way from a production pullback. And then I think when you look at it from an inventory standpoint, the market really, and I focus not necessarily on day supply, but I think when you look at inventory, day supply has been kind of hovering in the 50 to 60 range after the spike caused by the pullback in demand in April. But I think it's important to look at the level of inventory. So kind of sitting at that 2.5 million unit level, historic lows. Everything that's really been coming back from the plants into dealerships since the restart of plants in May through August has essentially gone out. So the inventory level has remained flat. I guess the good news is it hasn't declined further, but the market has not been able to get that inventory back to any normal type of level since that pullback in production back in April. So it's going to be something that we believe the industry is going to be fighting for, I think, through the remainder of the year. I think earlier expectations were, when demand wasn't expected to be quite as strong as it's been, that inventory gets back to normal levels by the fourth quarter. And I think that's just not going to happen at this point in time. In fact, when you look at some plants here in North America, production is really at capacity right now, especially the truck plants. They really can't squeeze any more out, even with overtime and certainly working longer shifts. I also wanted to use North America to illustrate how the pandemic has changed launches, vehicle launch activity, and then how that might affect the future as well. So this is looking at really a focus on 2020 launches. So we're looking at a market that was expecting to launch about 40 vehicles, 38 vehicles here from a production standpoint. So these are production launches within the year. So you can see, beginning of the year, we had a couple that got out of the gate certainly before the COVID outbreak. Tesla's Model Y is an example of that. So those launches were delayed, but the ramp up was delayed, and in some cases is still delayed, but they did get out of the gate. We did see, of those 38 launches, 12 of those were delayed within 2020. So saw a month or two delay, 3-month delay. 12 of them were delayed into 2021. There's a couple that actually got pushed into 2022. And then we've got, leaves us with about 9 launches that haven't been delayed, that are expected to launch now or into the fourth quarter of this year. So there's still a possibility some of those get delayed into 2021, but as of now, they have not been. So I think when you look at it from an average standpoint, you're looking at about 5.5 months for each of these launches on average were delayed. It affected about 25 assembly lines this year. and that equated to about 80% of those launches that were expected to hit this year have been affected. I think then from a priority standpoint, clearly getting vehicles like GM's large SUVs out, like the F-150 launch, the Mustang Mach-E launch, those, while they were affected, they are certainly the priorities, I think, when you look at some of the activities. One of the areas that certainly took a backseat, I think, is facelifts that actually weren't already fully developed. A lot of those were delayed or at least put on hold during this period. When you then look at it through the year, this year and into next year, here's kind of what the activity looks like. So as I said, there were several redesigns that were delayed this year. So we had 24 that were delayed this year. You're looking at next year, there's still quite a bit of activity delayed into 2021. So more than 15, about 17 vehicles next year have already been delayed. And that even has affected 2022 launches. So again, this is something that's going to be with us from an industry standpoint for the next couple of years. And you can see on a facelift standpoint as well, several facelift activities have been delayed. And then lastly, I think when you look at it, there were actually 8 launches, not in 2020 necessarily, because those were already developed, but 8 launches that we were expecting to hit the market through the next 2 to 3, 4 years have been actually canceled. So there have been some cancellations. So let's take a look at what the path forward looks like. I think when you look at the global light vehicle forecast, this is really a summary of kind of where we've come and where we see things at. So the blue line representing our current forecast, that red line is where our May forecast was. Again, as I said earlier, things have improved. So we're looking at about 75 million units now. We were down to about 70 million units back in May. So we've added nearly 5 million units back to the forecast. You can see how that has affected the next couple of years of that recovery. So the shape of the recoveries continues to be more of a V shape from an automotive standpoint. Looking at almost 84 million units in 2021 and almost back to that 90 million unit level, that very close to that 2019 level that we saw here, 90 million units by 2022. So picking up most of that volume in a couple of years. Cumulatively, though, the market is losing or has lost 30 million units from where our forecast was, which is that black line. That's where the forecast was prior to the pandemic. So again, we were expecting the market to get back above 95 million units by 2022. Now we're looking at a market that's about 90 million units by 2022. So there is a knock-on effect, certainly to this pandemic and the recovery in the auto sector. When you look at the ranges then, so this quadrant down here is looking at the forecast range. So the green dots are representing our current baseline forecast. So we put it in a range here. As I said, I think there's still some upside potential. There is some bias on certainly on the downside, and that's just really because of the uncertainty. I don't really think at this stage we're going to see a market that takes a strong pullback from where we are right now. But there's obvious risk associated with the remainder of the year, the remaining 3.5 months. So I think that's why we're still seeing a little bit of a downward bias, just because of a high level of uncertainty and just unknown not only how the markets around the world are going to behave, but also how consumers are going to behave, and is there enough inventory? All of those are circling around the market. As we look into 2021 and 2022, by 2022, you see a lower level or a lower band of risk and range, and it's more balanced by then. Again, 2021, we have I think a higher degree of uncertainty associated with just exactly how the recovery takes hold. But generally speaking, again, things have improved from where we were. So it's very likely that we'll continue to see that take place. When you look at some of that recovery and take it out into 2023, you see a market globally that's up about 8% on a compounded annual growth basis. So an average across that period of recovery at the 8% level. You can see the markets that are above that, Western Europe, a little bit stronger recovery, but really hovering around that global level. Because of the steep declines in India and some of the other emerging markets, Eastern Europe, Brazil, you see a stronger potential for recovery and expectation of recovery. But again, those come with high levels of risk because of the nature of those markets in general. China, about a 6.5%, the US is 6%, and then you have South Korea, which is coming in flat on a growth standpoint. But again, that's a market that's actually growing this year, even with the pandemic. So much stronger positions from a starting standpoint, as does China, than the rest of the market. And then a little bit deeper look at the U.S. recovery path. So this again is looking at our current forecast. We're at 13.9 million units. I think our initial view on what September is coming in at, again, is exceeding expectations. So as I suggested earlier, I think there is a strong possibility that we'll see a number that's a bit stronger than that. So probably in the low 14 million unit level. We do see a little over a million unit pickup over the next couple of years, 2022. And then we're approaching that 17 million unit level again by 2024, 2025. So certainly a lot of issues the market is dealing with here. The recovery itself, I think our expectation or our assumption is that there will be a second stimulus in terms of fiscal stimulus or financial stimulus for consumers that will help keep the market on track. If that doesn't happen, then obviously that's where we see that risk band come into effect, and we could see a lower level there. If consumers don't get that stimulus package, the economy likely will be at a steeper decline this year and may not recover as strong next year as well. Trade policy certainly has come back in order and in a potential headwind for the market. And then, of course, the election's a wild card as well for the auto market in general, as far as what that looks like. What does it look like for the economy? So obviously, those are driving factors as we wrap up 2021 and into 2020. Wrap up 2020 and into 2021. From a segmentation standpoint, again, looking at growth rates out to 2024, you can see the SUV market. So we're looking at a market that's about 7 to 8% on a total market level increase. So SUVs are holding their strong position, growing at the market, and this is all recovery based. So you see trucks holding there as well, premium at that level. Really, most vehicle segment types are increasing. So the sporty segment growing primarily because of the EV activity, EV driving some activity in the premium side as well. You see EV kind of playing a role all across these segment types. So we'll talk about that as well. The only major pullback is going to be a continued decline in the car segment. And that would have been stronger, I think, without EVs being in that segment as well. And then looking at overall global production levels. So I think when you look at the decline, again, 17% decline that I mentioned earlier, and that recovery path, it's going to follow a similar recovery path to what we're seeing on demand. We see volume getting back up to almost 93 million units by 2023. And again, I think the short-term risk is more related to capacity constraints, certainly in North America and parts of Europe, and we'll see how that plays out. But again, pre-COVID levels expected, not really until the end of the forecast horizon there. Utilization standpoint, this is again taking us back, seeing where the market has been hovering. So it's been a decline, is primarily if we look at the period of 2013 through 2019. It really has been a investment in new activity and new factories. A lot of that taking place in China, driving that lower utilization levels as those plants start to ramp up activity to support the growth in the globe. You see, obviously, a pandemic hitting the market here from a utilization standpoint globally, and this is partly due to just the lower levels. So right now, and the decline that we saw in April and in parts of May around the world, right now, as I mentioned, at least in North America, things are running at about as lean as they can from a utilization standpoint, at least temporarily. but still the world is about a 50% utilized level. Improving, getting back to the mid 60s. Globally speaking, we like to see, from a healthy standpoint, around 70%. Here in mature markets like North America and Europe, the target is typically around an 80% or higher utilization that is deemed healthy. So we're going to be below that healthy level, I think, certainly through the next several years, but recovery is on the way. So before I wrap things up, just wanted to give a little bit of perspective on, you saw EVs kind of hitting a lot of the different areas of the market, but I wanted to give some perspective on what the global BEV market or battery electric vehicle market looks like. So again, we're looking at a market, as I said, down for the year. So we're coming off of about 1.6 million units last year. You see the decline from expectations before COVID. So we were looking for a pretty substantial increase. But note, battery electric vehicles are still up about 200,000 units with our latest forecast expectation, our prelim forecast for this year, from where they were last year. So it's a 16% decline from where we were, the 2.2 million units, but it's still stronger than the 2019 level. And then I think as you look at that strong growth and recovery, not only is it recovery because of the pandemic, but it's also an expansion. In some cases, as I mentioned earlier, the regulatory environment is helping drive that, but it's also model activity driving a lot of that volume expansion to get us really to a volume, globally speaking, of about 15% share by 2030. Putting that in perspective, the U.S. is expected to be under the 10% level in that same period of time, but still a pretty substantial growth. And what's driving that growth, as I said, the regulatory environment, but it's also the number of models for sale and available. So you're looking at a market that was globally less than 100 vehicles available for sale. And these are models that we deem over 1,000 units globally from a sales standpoint. So we've taken out some of the really low model levels or models that aren't expected to perform on a global basis. Maybe they're just based in China, and again, very low levels. But still, look at that growth. So going from under 100 vehicles available for sale in 2019, by 2022, well over 300, and pushing that 450 vehicles on sale by 2025. Some of the key launches here, many of those, as you can see, are European and premium driven. But of course, the Model Y, you've got the strong expectations for the Ford Mustang Mach-E. And of course, the pickup truck segment is getting quite competitive with the RT1 from Rivian. Of course, Nikolai with all the attention of the Badger and the GM deal. GM's own Hummer, bringing the Hummer brand name back in the EV market space. Of course, the Cybertruck. So again, a lot of activity focused in that pickup segment here in North America. And with that, just a few thoughts. So as I mentioned, obviously things, we took a pretty deep decline this year. But I think the good news is the market is exceeding and continues to exceed expectations. There's still headwinds ahead of us, a lot of uncertainty ahead of us, but I think we are in a much better place than really expected to be if we just go back to that April-May timeframe to where we are today. So market continues to do well. The health of the industry and market, I think, again, has exceeded where we would expect it to be, and certainly where we were back in 2008, 2009. So again, if there's any good news to take out of this, it's certainly that. There is still some uncertainty ahead of us, obviously, where this market goes, what the fallout might look like down certainly in the supply base. But I think right now, given that inventory recovery that's underway, things are again performing pretty strongly. So with that, I'd be happy to turn it back over to Bruce and take some questions.
Hi, Jeff. Well, thank you for that. That's a lot of information to digest. And as we get into the Q&A part of our presentation, I want to remind viewers, send your questions to rpnevents@crane.com. That's should be scrolling across your screen. So please do that. We've got a couple here to start with. You mentioned the market continues to improve. Are you surprised by the performance of autos since the start of the pandemic? Has the risk to expectations increased or decreased?
It's a good point, and I tried to illustrate that when we look at various parts of the world, and I think most of the world, there's a couple of exceptions, but most of the world has certainly been exceeding where we thought things would be. And as forecaster, you never want to admit when you're wrong, but I'd like to be wrong in this way, where things are better than we expect them to be. So yeah, I would say things have exceeded expectations. You have markets like China, like South Korea, as I mentioned, actually performing pretty well during this. The substantial and rapid bounce back in China, the continued growth in South Korea are anomalies. So I think those are exceptions. But I think overall, when you look at those, the other markets, the main mature markets of North America, the markets of Europe, certainly the other parts of Asia, Japan, those are holding up quite well, and again, all exceeding expectations. South America's, while it's exceeded expectations, still I think is one that I'd be a little bit more concerned about. It's always been that market that tends to be quite volatile, and I think that likely will be holding with us. India as well. India again, coming from very low levels, zero vehicles sold in April to where we are now, is certainly remarkable.
I think you said there was a little bit of a pullback in August. Some of that might have had to do with the number of sales dates available, and Labor Day not being part of August this year, like it was last year. But you still expect kind of the forecast looks much better than it did back in the April, May time frame, but still expect it to remain a little bit below forecast for the remainder of the year.
Yes, so we expect it to be below where we were forecast. So kind of pre-pandemic forecast, we're expecting to remain below that level. But I think our forecast is relatively conservative. I think just because of the high level of uncertainty, and I think even though there's still downside risk associated with the forecast, I think right now it's feeling like each month we're still, even though we've been increasing our forecast, the months are still coming in a little bit stronger than expectations. So yeah, obviously we knew there were less selling days in August, and that there wasn't a Labor Day effect here in the U.S. anyway in this month. So we knew it was going to be down, but it wasn't down as much as expected. And again, September is off to a little bit stronger start. Frankly, I'm wondering where these sales are coming from, because they're just, in many cases, there's not a lot of inventory out there, especially on the truck side of the market. I know from a personal standpoint, just talking with friends and neighbors, many of them are still sitting on their leased vehicles that have been running month to month and extended because they just can't find a replacement vehicle. So I think that's potentially some upside to the market forecast. Is we're still working through this transition that we all went through, and I think there's still we haven't seen all the demand come back from a pent up standpoint, but a lot of it has already. So I think that's one of the question marks as we look at the remainder of the year.
It kind of leads us into the next question. Can production meet demand in the U.S.? It seems like inventories remains very low. When equilibrium returns, what does that mean for production and suppliers?
Yeah, that's a good question. I think the numbers are running right now so strong. You've got plants just about every tier of the supply base, at least in some case, are running about as much overtime and working weekends and full shift capacities as much as possible to get that inventory built back up. So that's kind of the picture right now. I think there's still some risk to the remainder of the year. I think we're going to be in this low inventory level all the way through 2020, probably into the beginning of 2021 before we start to see some of that come back. And so I guess if you're looking for a vehicle, you're still probably going to struggle to find exactly what you're looking for, or find a deal. I think the deals are going to be tough to come by as well. They're just otherwise. I think if the inventory was there, you'd see a higher use of incentives also. So we'll have to see how that plays out and how that affects volume. But I think the market's going to struggle from a supply standpoint to get us back there by the end of the year. Now, as we look at 2021 and 2022, the demand is recovering, and certainly the numbers for production will rise as well for the supply base. But I think the level of the run rate that we're seeing right now isn't going to be sustainable. So that's not something that will continue once we get that equilibrium back and inventory rebuilt. So I think you're going to see a pullback of the run rate, even though production levels are going to increase just because of the coming from that low point back in April.
Okay, one of our viewers wants to know why it seems that Europe has been more negatively impacted by COVID than North America.
It has from a volume standpoint. And the interesting thing, there's more incentive, at least vehicle related incentive in Europe taking place. But I think the response or the financial incentive, the stimulus package, for example, was quite robust here in the U.S. And I think that helped manage through this transitional period, and why we're putting a lot of weight on the second stimulus having an impact on keeping the auto industry volume at the level that we see in recovery continuing. I think when you look, obviously, you look across Europe and you've got a series of markets more similar to states here in the U.S. And I think there's the U.S. has certainly had different pockets of states outperforming each other, and you're seeing that in Europe as well. But as a whole, the market, Western Europe, has been hit harder than the U.S. And part of that, I think, is just the response, the way the economies have developed, and the position of the strength of the economy in Europe, kind of heading into COVID. So the strength of the U.S. economy was obviously there. Interest rates at the low levels are supporting financing and activity as well. So I think the U.S. market was in just a much stronger position going in, and I think the overall response has been a little stronger as well.
How much of your expectations for the U.S. market are taking into account a second stimulus? What happens to the forecast if there isn't a second stimulus?
Absolutely. So our forecast is not only from a GDP standpoint, is expecting a second stimulus, but also from an auto standpoint. So the auto forecast is as well. I think if we don't get it, we're going to see confidence take a further hit. You'll definitely see the stock market take a hit as well. Obviously, there's a little more volatility in the last week or so in the stock market anyway, and I think that will continue to be the case. So without a deal, I think the recovery path that we're on takes a substantial downward direction. Now, at what level and how far does it deviate from where we're expecting is difficult to say. It's really going to be how consumers respond to that. But certainly, I think a lot is hinging the recovery that we're seeing, and the stability, more importantly, the stability that we're seeing is hinging on at least a further stimulus to kind of crutch us back to full recovery.
Let's talk a little bit more about battery electric vehicle markets. You touched on that quite a bit. Expected to grow significantly over the next several years. What do you make of all the startups in the BEV space? Are these hyper reality?
Yes, they are hype and reality in some cases. So I think it depends on who they are. I think if you looked, let's use Nikola as an example. If you look at Nikola before the GM deal, I would say, and maybe even still, that was a lot more hype. Reality could be there, but I think it was certainly the stock performance was a lot of hype. That was a brand that had a vehicle taking, developing a vehicle, had a prototype, taking deposits, didn't have manufacturing, didn't obviously have the vehicle fully developed. So I think there were a lot of question marks, as there are with a lot of the other startups on, what is reality here? Is this, is this something that is, are they going to be able to fund this through the full development phase? And I think that's one of the major questions when you look at these startups is do they have the funding necessary to keep going? We've seen failed startups and those that have run out of funding already. There's quite a few others that are still trying to get that funding. In the case of Rivian got their funding, they have their support. They're in a strong position now to launch. Obviously, COVID delayed their launch into next year, but that's one to keep an eye on. Lucid's getting a lot of attention, certainly with their the Air that they just showed last week as well. So I think that's one that feels like it's got some substance behind it as well. And then of course everyone wants to be the next Tesla. So I think that's driving a lot of this activity. So there are going to be more failed startups than probably those that make it. But I think at this point when we evaluate them, it's is there funding? What's behind it? Do they have a plant? Can they actually build the vehicle? And I think that's a big question mark with a lot of these. Until you have a plant, you can't launch a vehicle without a plant. So, or at least without contracting someone to build it for you.
Now, when we're talking electric vehicles, U.S. is lags behind Europe, China. You said in your talk, globally by 2030, you're expecting a 15% global share for electric vehicles, 10% in the U.S. What is it that's going to turn the switch on? Right now, U.S. still has pickups, SUVs, big vehicles that are dominating the market. Oil prices, gas prices are low. Mm-hmm. So what's it going to take to get the U.S. to catch up, or at least start going in the upper direction?
So I think when you look at it, there are a few things driving this. Certainly, you've got to look at demand. You've got to look at, do consumers want these vehicles? And I think the answer is generally yes. I think there's a lot more interest and attention. It's about availability of vehicles in the right segments. So you mentioned trucks and SUVs dominating the U.S. market, which is absolutely the case. We're now seeing attention of EVs into these segments. So put an EV in a segment where consumers want to buy a vehicle, and I think you've got a better shot at it instead of putting everything on the car side of the business. So I think that's a factor. Price is still a factor, even with the $7,500 incentive on those, those that still have that. It's infrastructure. That's a big piece. So obviously, charging infrastructure, technology around that. So if you're on a road trip, you don't want to have to go out of your way to find a charging station, and then when you do, find out that you've got to wait 2 hours in a line before you even get to a charger, and then wait another hour to two to get enough charge to get down the road again. So all of those are factors. I think battery life, range is becoming less of a factor than it was previously. We're starting to see a pretty substantial boost, out of the 200-mile range, 300-mile range. We're now hearing and seeing, up to 600 miles being taunted out there. So I think that's becoming less of an issue, but it still comes down to convenience, price, and then obviously vehicle choice.
I want to ask a little bit about plant utilization levels. You said they were down close to 50%. You like to see it 70%. 80% are higher in mature markets like US, Western Europe. If these levels stay low, what sort of long-term impact could have on potentials for restructuring, closures, those sorts of activity?
Yeah, and that's honestly, utilization is something the industry was dealing with before COVID on a global basis. As I illustrated, it really was in a state of decline from a utilization standpoint with all that heavy investment that's taken place over the last 5 to 7 years. It's a risk. I think if the market does not get back to a utilization that is deemed healthy, and there are strong pockets in a lot of the markets that are underutilized. I mean, Europe, as an example, has a lot of excess capacity. I mean, we have an amount here in North America, but Europe's sitting on a lot of excess capacity. You've got this. If I tie this into the electric vehicle comments I made earlier, you've got a lot of investment that's poured into those markets, converting plants or building new plants that are EV focused. Again, if that volume doesn't get up to levels that are sustainable or there to support those plants' operations, it's going to be a struggle, and eventually that does lead to consolidation or potential plant closures. I think overall, putting this in a broader picture of just the investment that's poured into the industry and new technology, whether it's electrification or mobility and autonomous vehicles, this all plays together. So those low utilization levels, they're draining some of that investment that could go towards future activities. And I think that leads to tough decisions if they don't improve, both from just where to put investment. Do you have funds for investment, and ultimately the survival of some companies or plants in that case. So I think it's a serious problem, but it ties into a lot of other concerns and other issues out there, which is why I think you're starting to see some tie-ups. So GM with Honda, Ford and Volkswagen, GM with Nikola. I think all of these have to do with spreading out development costs and trying to speed up some of the development needs into these new technologies.
Okay, Jeff, I think we have time for one more question. Tying things together, what would be your message to supply base to automotive during these uncertain times? What do they need to do to survive on one hand and thrive, not only survive, but thrive going forward? What are some of the things they need to do?
Sure. And this may sound simple. It's certainly harder to execute, but I think one of the key things to do is remain flexible and constantly monitor the environment. We know that the auto industry, while if as an outsider you might think the auto industry isn't very dynamic or interesting, but it's very fluid. Obviously, all of us in the industry know things can change very quickly. So they may be outperforming now, but there could be a driver or something that changes that tomorrow. So I think it's staying on top of the where things are and exactly what's driving the industry, and obviously using information to drive decisions there, but remaining flexible, doing your homework. So if you're looking at your customer base, if you're a supplier and looking at the vehicle manufacturers, and looking at some of these startups, maybe you're being asked to quote on some of these startups. I would just say do your homework and make sure that they're real, and watch the pricing on some of these and the volume expectations. So the key though, I think, is during all of this, looking through it and remaining flexible.
All right. Thank you, Jeff. I really appreciate your helping kick off the second week of iTech 2020. The automotive industry is key to our audience, and they definitely want a glimpse of what the future may hold, particularly given these uncertain times we're living in. With that, I also want to thank our audience for tuning in. Please continue to tune in for the rest of this week. We've got a lot more planned for you. I also want to give a big thanks to our sponsors for supporting iTech Virtual 2020. If you want to revisit this session or any others from the conference, they will be available on Rubber and Plastics News website at rubbernews.com. If you would like to purchase papers from any of the presentations at iTech, visit itech-tireshow.com to do so. Also, don't forget that to connect with your colleagues here through the virtual networking program, which can be found on the left-hand side of your screen. Simply click on the Meet icon to start connecting with fellow iTech attendees. Thanks for joining us today, and please enjoy the second week of iTech 2020, the virtual edition.